The standard approach has always been the younger investors should always focus on growth. The older investors should move towards income because the retirees need it to live. And the younger people, well, they've got an employment salary, so they got that income, so they should be growing so that they have money saved away as a retirement. If you went back prior to these covered call ETFs showing up that are providing these amazing yields, the only way you could do income was through either dividends or through bonds or GICs. Well, if you're talking about the growth of an equity stock versus a GIC or a bond, yeah, absolutely. Common sense would tell you is like, if you're young, put your money in growth, because honestly, you're not going to get that kind of money out of a GIC or a bond or a or a dividend, because even your best paying dividends, we're only paying like 5-6%. Most of them are not even that. They're like 3 or 4%. So yeah, that was the thinking. But in my opinion, what's good for the goose is good for the gander. If I need income and I have an investment tool like these covered call ETFs that can generate safely 10 to 20% and aggressively 20, 30, 40, 50%, why am I not now rethinking that whole strategy of saying, why do the youth have to sit here and wait for 30, 40 years for them to put money into this investment until they can actually retire? And I'm going to use my daughters as an example. My youngest daughter has a modest income. If she didn't have a boyfriend and stuff, she couldn't live on her own because she wouldn't have enough salary to do it. Who are the people that need money more? I'm going to say right now, I won't say everybody, but a lot of retirees, they retired with 6-figure salaries. They retired with pensions. Yeah, sure, they need the money because that's going to be the money that comes in. But I'm going to tell you right now, my daughter having $600, $700, $1,000 a month coming in, well, that's about 30% of, let's say 30% of her existing salary. That pays for things that she would not have been able to easily pay for. And then my oldest daughter, well, she has a good salary, but she was putting money into RRSPs so that she could get her tax deduction because of her higher salary. But the other thing is so she could do what everyone tells her to do, and that is save money for your retirement. Well, the nice part is, by having this TFSA, which is basically the government's best gift they've given to investors and Canadians, having this TFSA, filling it up with some covered call ETFs that generate, $700 or $100 or $1,000 a month. Now she does not have to contribute that $200 a month out of her employment earnings. She actually stopped that, and she's actually putting in $500 a month in TFSA earnings, and basically taking it out tax-free, putting it into her RSP, collecting the tax deduction, and actually saving now for her retirement without her using employment income to do it.